Welcome back to Forex in 9 minutes, where I give you the sauce in 9 minutes or less. If you want to learn how to identify a break of structure, a false break of structure, and a shift of market structure, this video is for you. I'll explain what qualifies as a break of structure, a shift of structure, and give you a way to identify a false break of structure, also known as a stop hunt. So watch till the end, and if you find value in this type of content, consider giving a like, subscribing, and turning on notifications so you know when the next episode is released. Forex in 9 minutes. Let's go. A break of market structure occurs when price moves outside of the market structure range in a continuation of the trend, and generally it breaks through weak levels of support or resistance where the last impulsive wave ended. So looking at this example, we have an impulsive wave that defines the current market structure range. We know that this higher high is a weak level of resistance because it is expected to be taken because we're in an uptrend. When price breaks through this structural point, breaks this high, makes another high, we have a break of structure and potentially a new defined market structure range. So moving up to the next low and identifying this high, this would become our new market structure range because it is the range that creates an impulsive wave that breaks structure. The break of structure needs to have a valid retracement. So once this higher low leads to a break of structure and creates a higher high, this higher high needs to have a valid retracement or initiate a higher low in order for this to be valid. The break of structure won't be valid if this higher high creates a lower low by having a breakdown of the structure range. If this occurs, then we're potentially in the area of having a reversal, or it could potentially mean that this break of structure here is actually a false break of structure because price could potentially break that low, make a lower low, make a lower high, and then make another lower low and lead to a reversal that way. And then that would actually create a new market structure range this way, and it would have a valid retracement and then another break of structure. The same thing applies to the downtrend. I'm doing most of these examples for uptrends, but everything that applies for uptrend can be reversed for a downtrend. And you know, in a downtrend, our lower lows are weak levels of support and they're expected to be taken. So once we have a market structure range as such, where price is trading, it makes a valid retracement in that it doesn't create a higher high, but rather creates a lower high, and that lower high leads to a lower low and creates a break of structure. Our trading range now changes, and this becomes the new trading range until price breaks out one way or another. False breaks of structure. You don't really know it's a false break of structure until kind of after it happens. When a false break of structure occurs, it looks like a break of structure because you have a trading range. If we're talking about this impulsive wave and price breaks above that trading range for a break of structure, but as soon as price does not have a valid retracement where this higher high needs to retrace and make a higher low, this would be a valid retracement, and that would mean this would be a valid break of structure. As soon as price trades below the last valid higher low in this bullish scenario, now we know that this break of structure here is actually a stop hunt or a false break of structure. And that's the part that helps define that, is the fact that it did not have a valid retracement after this break of structure occurred. Now typically this occurs with price not having a strong close on the given time frame. On a lower time frame, you may have multiple candles that close above and would give you indication that it is a strong break of structure. But on the given time frame, so if it's a 1 hour time frame, we need to see 1 hour candles perform this proper body close above a level, because you'll see a wick on the 1 hour, but on the 15-minute you may have multiple candles that clear that. Now you often will see this same type of behavior within a trading range. So price will trade between two well-defined levels of support and resistance, make a breakout, and then trade back into the range, and then eventually, or more often than not, will trade below the last valid low. So if this is the last valid low, we can't count these as valid because these lows did not make higher highs, except for this one. This low is a valid low because it was able to break structure, so that validates itself. So price trades beneath this low here. Now sometimes this low may be that high because oftentimes within a range, price will start to form structure, start to make a low, then all of a sudden it makes a higher low, and then it breaks out, and you think the price is going to break out, but then price comes back and takes this low, proving that this is actually a fake out. And it is the exact same thing for a bearish scenario where price comes down, makes structure, it breaks, has a breaker structure, and then will trade back above that last valid high, and then this would be the actual stop hunt in this area. So that would give us a stop hunt in a bearish scenario as price rallies up. This could be infuriating if you took a trade in this area playing this breakout only to have price reverse against you because your stop loss was probably beneath here and you traded that breakout. So that's what a false break structure is. Now, false breaker structures can also be known as false breakouts, fake outs, liquidity grabs, manipulation, or you could simply just call it a stop hunt. Price moves towards liquidity, and when the market maker, they want to push price up to bring it back down, and they want to bring price down to make it go back up. Because if they want to sell, they want to get it as high as possible before they drop the price. If they want to buy, they want to get price as low as possible before they run the price up. And that's how it applies to stop hunts or false breaks of structure. A shift of market structure or shift of structure is a failure of a higher low to create a higher high in an uptrend, or the failure of a lower high to create a lower low in a downtrend. The shift of structure serves as a warning that the trend may be changing for reversal or price may be entering a range. So what generally happens is a higher low has the job and is validated by making a higher high. When it fails to make a higher high, it becomes a weak level of support and it is targeted for retest or reversal. So price can come back down here, make an equal low, which would indicate that price may be entering a ranging condition. It may start trading within a defined range, or price can make a lower low, which would be a reversal. In a downtrend, you have a lower high that has the job of making a lower low. When it fails to do so, price can either make a equal high, which would indicate a ranging condition might be starting, or make a reversal. Now, in both of these circumstances, we have to remember our boundaries of the trading range or the market structure range. The last valid low is this low. This low is not valid because it was not able to create a breaker structure and it was not able to make a higher high. So once this low is broken, then we have confirmation that we're in a reversal. This is like the precursor to the reversal. This is the early warning system that market structure gives us. When we see the shift of market structure, it's indicative of a loss of bullish momentum in this scenario or bearish momentum in this scenario, and price is not able to continue making those higher highs. And if it's not making the higher highs, it's going to fail at making the higher lows. In the next episode, we'll continue with market structure, where I'll explain change of character reversal patterns and how to qualify them. So make sure to tune in to the next episode of Forex in 9 minutes.